But what do you think will be same in 2025 as 2024, and what do you think is going to be different? Because 2024, for instance, had that massive FII outflows as well. I mean, you can say that the primary market issuances were more, and you balance it out, the argument that Sameer Arora was also making. But what do you think is going to be different in 2025 versus 2024?
I think, firstly, what could continue to play out in 25 is domestic liquidity. That I think is going to be extremely important. It's going to be very, very crucial for our markets, and I continue to believe that clearly the case for Indian equities and for our domestic savers to become investors remains as compelling as what it was a year ago, 3 years ago, or 5 years ago. I think that's something which is a long-term theme. The whole financialization of savings is something which will continue to play out, and therefore 25 will continue to be the same. Second, in terms of what will continue to play out, will be essentially the government's focus on fiscal discipline. The path of fiscal consolidation will continue, which augurs very well for financial markets. What could be very different is maybe some of the large caps, which have honestly underperformed, for the last year or 2 years. Maybe there might just be a kind of a comeback, especially if FPIs and FIs stop selling and probably start to buy. For them, clearly, the large caps could be basically the low-hanging fruit. So that's something which could be very different from what we have seen over maybe the last year or so.
Okay, you talked about fiscal deficit, so I just want to complete that point. You're expecting it to remain the same in the sense that the glide path will continue. Yeah. However, part of the street believes it wouldn't be too bad if they loosen the purse string a bit, given the fact capex in first half of the year hasn't been great. The entire economy, in the sense of the middle level and the mass segment, is a bit weak right now. And it wouldn't be too bad if they loosen their purse strings and let go of fiscal deficit for a year.
Yes, but these are situations which are always very, very tricky. Maybe from 4.9, maybe we don't go down towards the 4.5, but even if we remain below 5, I still think that would essentially be a very welcome kind of a measure or a target to have. Clearly, we still depend a lot on the government spending, especially in areas like infrastructure, energy, defense, railways. These are really some of the big impact sectors, and clearly it has to be the government which will have to take the lead or remain in the lead, be the Pied Piper, and continue to ensure that based on its own investment, the private sector tries to chip in. So clearly I think that's going to be very, very important, and therefore it'd be good. The other thing, of course, is that at the state government levels, of course, you clearly have the handouts which are happening, which is basically going to be a bedrock for consumption. All the schemes which the individual state governments have been doing, which is, you could call them as direct benefit transfers, direct transfers, income transfers, whatever you call them. But so both are these two important things. I think at the central government level, they will continue to focus on infrastructure. The state government levels, they'll continue to focus on direct benefit transfers. And I think these are two very, very important kind of triggers for the markets.
Nilesh, you also touched upon government spending, so that's what I wanted to ask you. The big event in the first half of this year now is also going to be the union budget. Do you think on the back of some announcements that we're expecting to hear in the budget, the likes of your defense, capex, infra-related stocks could do well, or rather outperform the usual defensives like your IT, pharma and consumer?